Hi, I'm Scott Starratt with Starratt Wealth Management, a part of Canaccord Genuity Wealth Management. So today I want to touch base about the investments, what's going on in the market, what's going on in portfolios, as well as just quickly go through what's going to be happening in the next couple of months for tax. Let's start with Tony Dwyer is the chief strategist at Canaccord Genuity. And one of the things that Tony has mentioned in the last couple of days is the fact that, he's just the pilot of the plane. The market will do whatever it does. And so I thought that was interesting. So I kind of taken over that, or borrowed it from him, shall we say, and kind of expanded upon it. So the way I look at things right now is, yes, Starratt Wealth Management, maybe the pilot, definitely with help from yourselves. And then what we end up doing is we end up flying the plane. And if you can picture this, we're cruising along right now. Of course, everybody's sitting in first class. They have just finished their meal, maybe an after dinner drink. Some people are out of their seats, milling about. But the one thing that we know is when flying is that there can be turbulence. And one of the things we also know is that if you're out walking around or your seatbelt's off, that turbulence can be quite damaging. And so two things come into mind with that. First is how focused we are in trying to prevent the portfolio turbulence. We spent the last multiple years really looking at it from the standpoint of trying to achieve these market returns without too much turbulence along the way. But one of the things we also know is that with turbulence, it very rarely crashes. So in the markets right now, we would expect some turbulence going forward, and we do have everybody's seatbelts are fastened, but we see the turbulence as a good opportunity. If it does come, we see this as a way that we can lower our cash balances, maybe lower some of the safer investments in the portfolio and move more into the market bucket. All that being said, right now we still expect the plane to land. There's no issues with the equipment, but we are expecting that turbulence to occur. And one of the reasons that the turbulence in the market for the last week or so has been occurring has been this idea that stocks, and I'm oversimplifying it greatly, but stocks can be pigeonholed into two categories, one being growth and one being value. And it's just like it sounds like. The value side are companies that are usually very strong, mature businesses that often will generate a fair amount of cash. Sometimes that cash is used to pay dividends. Sometimes it's used just to reinvest in the business. And often value stocks can be very cheap for whatever reason. Maybe it's the industry they're in. Maybe it's something macro that's happening in the world, in the global world, or maybe it's something different altogether. Growth investments, on the other hand, are companies that are aggressively growing. When we think about growth investments, we often think about tech companies who can or have been growing their earnings by 30% plus a year. Now, at some point that changes, and sometimes there's companies that will go from growth to value and then back to growth again. Microsoft, I think, is a great example of that. If you look back over the years, Microsoft had kind of peaked out at one point because their Office products and all the other products that they have in Windows had pretty well been completely adopted by the world. But then they got into cloud computing, and so then they became a growth stock again. In any case, what I'm trying to say is that this transition between growth and value can create a lot of volatility. And so we have some managers that are very, very good at growth, some managers that are very, very good at value, and then there's a couple that do both. So what we've seen with the ones that do both, we have seen them lighten up on, say, for example, their technology companies or pharmaceutical companies, and instead go more into the cyclical reopening companies. This is one of the reasons why we've seen energy stocks do so well in the last month, or other companies like mining and all these industrial companies that tend, when the economy is doing well, to do well themselves. And the hope is, and I think it's a realistic hope, is that especially in the United States, they'll be fully vaccinated, or anybody that wants to have it, by early summer. And that means that their economy can go booming ahead. There are still a lot of people unemployed. There's still a lot of industries that are hurting. But we feel that the time has come to, at some point, decide whether we're going to continue to play it safe or whether we're going to expose more money to the market bucket. Like I said, waiting for that signal to be there as a pilot. We're just doing what's given to us, and so we're just flying the plane in the direction that we think will be successful for everyone at the end of the day. A lot of this ups and downs and between stocks and bonds and growth and value stock is really driven by huge amounts of money that's in the market. I mentioned last month of how much cash is available or near cash, i.e. mutual funds, stocks, bonds, that people can sell immediately. And it's still at a record high. So we don't anticipate much to change with that in the near term. The biggest issue right now, and one of the big reasons why interest rates on the bond side have gone from about 0.6% at the bottom about 11 months ago or so to about 1.5% today, and that's a 10-year US Treasury, is because of this fear of inflation. And so there's the battle that's occurring between reflation, which is great, people get back to work, the economy starts to move ahead, very, very positive, and we like reflation. Inflation is, on the other hand, the cost of goods going up. Now, we know that if you have been to a grocery store in the last month, we know there's inflation. We know that if you look or think back to those of you who were out of the house back last April, gasoline dropped to somewhere in the neighborhood of 86 cents here in Alberta per liter. And so now we're at, let's say, $1.20 per liter. That's inflation if you compare it to a year ago. So the market over the next little bit is really going to struggle with this because the fear is if it is inflation and the Federal Reserve, which is the US central bank, and all the other central banks in the world continue to print money and continue to be very, very accommodating with their interest rates, that we could get into inflation. And the problem with inflation is that it can't really be turned off immediately. It takes time. Those of us who were, had mortgages in 82 or loans in 1982, remember, how long and how painful it was to stop the inflation from the late 70s. And so, not suggesting we're going to get anywhere near that right now, but it's definitely a concern that people have, is with all this liquidity, all this cash in the system, how is the inflation going to work going forward? And is it going to be realistic for the central banks to be able to turn on a dime and to be able to stop inflation through higher interest rates without the interest rates going crazy? So it's something we're very, very cognizant of, and it's something that we've been spending a lot of time thinking about over the last month or two. Again, February was a very strong month for client portfolios and relatively strong for the market in general. We're quite happy with how things are going. Those we've had reviews with hear me say, there's nothing that I'm concerned about right now in the portfolios. Very, very happy. We're just waiting for the right signal to be given to us in order to maybe switch things out and become more market focused, as opposed to keeping or playing it super safe. One of the other things I want to touch base on was the tax stuff and what's going on there. So if you recall, the T5 slips, as well as some of the other background data like cost summaries, like trading disposition summaries to tell you your capital gains and losses, they all are required to go out by March 1st. So obviously they're out now. The second part of that is the T3 slips or the T5013 slips. So these typically are for mutual funds or limited partnerships or other types of products. They actually don't have to be out till March the 31st. And of course, filing still continues to be by April the 30th. The government or CRA has not said whether they're going to extend that this year again, like they did last year. In any case, we're assuming they aren't. And so we expect for the next few weeks for the T3 slips to start going out. Some of the companies are much faster than others because of the type of investments they have in their portfolios, and so they've been sending those out right now. And so you also all should have received your checklist. So what we did this year is we combined the things that we thought was going to come from Richardson's as well as the stuff that's coming from Canaccord, and we combined it together into one checklist. We're pretty sure that we're accurate there, but again, we developed the checklist about a month ago, so some things can change. We'll communicate with you if things do change. The last thing to touch base on, it's a little bit of a teaser of a chat I'm probably going to have in the next month or two, is the idea that, you know, we think the portfolios are great. You know, completely biased, of course. But we also wanted to, and we do this often, but not to this extent, is we wanted to get a third party involved to actually evaluate the portfolio, to remove maybe any of the concerns or bias that we have in our heads, and just get them to look at the numbers. Look at the numbers, look at the investments, look at the percentage of investments in models, and how does it look? And so they're right in the middle of digging through all that right now. Obviously, it's a lot of work as they have to go through each investment. They have to pull the performance data from each investment. They have to pull the volatility from each investment and what they hold in each investment, and combine it together into kind of a master program or a master model. And then they report back to us. However, one of the things I want to share, because I have seen parts of the report already, one of the things I wanted to share was the idea that of our fixed income side of the portfolio, so our yield bucket. They found that quite interesting in that there's two, in the big scheme of things, there's two types of bonds. There's high yield or junk bonds they're referred to. So these are companies that are not investment grade. You know, they may be lower quality of credit, yet still could be good companies, and they're still well-known companies if I were to list a whole bunch of these high yield bonds. But they tend to be a little bit equity-like in that they follow the stock market a little bit, and again, the companies tend to be very not as rock solid as maybe some of the other ones are in the investment grade sleeve. And so what you would expect, obviously, from that, because you're taking more risk, you would expect better returns. And so the flip side to that is the investment grade bucket. So these are corporations, companies that have really strong credit ratings. So you think in Canada of the banks, you think of the life insurance companies, you think of some of the big utilities. They would all be companies that would have investment grade ratings. And so one of the things that this company found with our portfolio and our yield bucket was that we had on the good times, we had the attributes of a high yield portfolio, but in the bad times, we had attributes of the investment grade portfolio. That's almost perfect. And the reason for that is that, you know, investment grade bonds usually don't drop very much because they're very solid companies when times are bad. On the other hand, high yield bonds can get hit when times are bad. And the opposite's true too. Right now, investment grade bonds are paying very little. High yield bonds aren't paying much better, but they, you know, are paying at least a couple % better than what the investment grade bonds are. So in periods like this, we're actually seeing this company, we're seeing the portfolio do better in the high yield side. So all this to say that we're quite happy that we're still looking at ideas. We're still looking at ways to improve the portfolios. And like I said, in the next couple of months, I'll have a final report from them, and I'll just do a chat to kind of go through that. Just, you know, if you're interested, if you're not interested, obviously the fast forward button is there to go through. I think that's about it for now. If you do have any questions or concerns, please do reach out to Jim or myself or anyone else on the team, Angela and Heng Yi. We're all looking forward to chatting with you. I mean, it's kind of hard to not meet face to face these days, but more than happy to chat on the phone, set up a Zoom call or something like that. And as I say at the end of every month, if you do have any friends or family that are interested in hearing me drone on, feel free to forward this to them or any of the other videos. All of our videos are archived on our website, www.starrattwealth.com. So more than happy to go into there and watch any videos from the past and forward them on or mention us to friends or family. We're always looking for good quality people to chat with. Thanks again.